Hello and welcome to our first investment occurrence for the first quarter of 2026. I'm Tim Chubb, Chief Investment Officer here at Girard. For those of you who read our client quarterly letter, you'll know we spent some time with the Eagles this quarter. Hotel California turns 50 this year, and the album Central Idea, a place that welcomes you warmly and then makes it quietly impossible to leave, felt like an unusually accurate description of the market environment that we just navigated for the first quarter of the year. And we're going to walk through why. The performance dashboard this quarter tells a story of broad but uneven declines. The markets entered 2026 on solid footing, and last year's gains were roughly 75% earnings driven rather than multiple expansion driven, which is a much healthier foundation than the valuation fueled rallies of the late 1990s. But that foundation was quickly tested. Large cap US stocks fell roughly 4% for the quarter, and the NASDAQ entered correction territory off more than 10% from its October peak. Mid and small cap domestic stocks were notable exceptions, both posting modest gains as market leadership began to broaden in a meaningful way for the first time in several years. International equities held up relatively well, while bonds provided modest but meaningful ballast as volatility picked up sharply in March. Beneath the index numbers, the composition of leadership significantly shifted. Value stocks, small cap stocks, and equal weighted indices outperformed large cap growth and the broader technology sector. And despite weaker sentiment, corporate fundamentals remained resilient. Fourth quarter 2025 earnings growth came in at nearly 14%, significantly beating the 7.1% that was expected at the start of the period. And full year 2026 earnings forecasts have also been revised higher to almost 17% from 13.1 to begin the quarter. The environment was volatile, but the underlying earnings story continued to hold. Let's look at what was happening under the surface in the S&P 500. After 3 consecutive years driving index returns, the Magnificent Seven, the handful of mega cap technology and consumer companies that dominated the 2023 and 2024 rallies, experienced a meaningful reversal in the first quarter. Collectively, they declined more than 10%, while the broader market fell by less than 5%. This divergence is actually encouraging news. The average stock in the S&P 500 held up considerably better than the headline numbers suggest, and both the equal weighted index and the S&P 493, everyone outside the largest 7 names, outperformed the cap weighted benchmark. Broad participation in a market is far more durable foundation than leadership concentrated in just a handful of names. The earnings story has also reinforced this. The growth gap between the Magnificent Seven and the rest of the index is starting to close. And the Mag 7 grew earnings at more than 27% in the fourth quarter, but the rest of the S&P grew at nearly 10%, and consensus expects that gap to continue to further narrow in the year. Dominant sector story this quarter was what traders quickly dubbed the SaaS apocalypse, a severe sell-off in software as a service companies that resulted in the software ETF falling roughly 14% at its worst, its most severe stretch since 2008. The chart here tells a more nuanced story than the headline. Semiconductor stocks, the picks and shovels, the AI infrastructure build out, held up considerably better, and that's because the market made an important distinction at the infrastructure layer. Demand for chips, data centers, and compute is not in question, but the question is what happens at the application layer, the software companies that have long charged premium prices for tasks that AI tools may now be able to perform. But here's where we think the market overshot. The sell-off was really indiscriminate. It didn't distinguish between software businesses that sit at the periphery of workflows and the kind that can be bypassed, bundled away, or replaced by lighter weight AI tools, and the businesses that are so deeply embedded in customer operations that replacing them would mean rebuilding core infrastructure. The risk in software is real, but it's concentrated. It lives in businesses with weak differentiation, peripheral workflow positions, and aggressive capital structures that were built for a world of abundant capital and unchallenged pricing power. That is not how our portfolios have been positioned, and we believe the indiscriminate nature of the sell-off has created as many opportunities as it has confirmed risks. 3 macro shocks arrived in rapid succession this quarter, each one compounding the last. First, in late February, the Supreme Court ruled 6-3 that the administration's primary tariff authority under the International Emergency Economic Powers Act was unconstitutional. That positive market reaction, the S&P 500 rose about 0.5% that day, lasting approximately 2 hours, since by that afternoon, the executive branch had invoked a separate statute to impose a 15% global tariff effective February 24th, and trade investigations were open in nearly 80 countries. The tariff mechanism changed, but the uncertainty did not, at least for now. The second shock was geopolitical. On February 28th, military strikes in Iran led to the effective closure of the Strait of Hormuz, the choke point for roughly 20% of the world's petroleum supply and equal share of the global liquid natural gas trade. Brent crude surged from the mid 60s to a peak near $115 a barrel. And energy stocks gained over 10% in March alone as consumer discretionary companies fell by more than 7. The IEA coordinated a record release of strategic reserves, but only about 20 days of coverage, offering a bridge but not a permanent solution. And these compounding supply shocks are certainly complicating the bind that the Federal Reserve is in right now. At the March 18th meeting, the Fed held rates steady but raised its 2026 core PCE inflation forecast to 2.7% and modestly lifted its GDP projection as well. The energy and tariff shocks in first quarter have pushed goods prices sharply higher again, just as the labor market data has showed a clear deceleration in payroll growth over the last year. Cutting rates risks reigniting inflation, while holding rates risks fracturing a labor market that has been resilient but not immune. The Fed enters the second quarter without a clear path in either direction. Despite everything that unfolded this quarter, history offers a measured basis for optimism with one very specific caveat. Looking back at geopolitical shocks since the Second World War, the data is remarkably consistent. Near-term returns in the first 3 months after the onset of a conflict are muted, averaging close to zero, but by 6 months and 12 months out, returns are statistically indistinguishable from normal periods. And markets have been higher 12 months after the onset of an armed conflict, roughly 70% of the time, with an average 12-month return of nearly 8%. And as you can see in the chart, the pattern holds across decades and across conflicts of very different character. The caveat, and that's the one that matters the most right now, is energy. The two worst geopolitical drawdowns in the post-war era both involved oil supply disruptions. The 1973 Arab oil embargo was the most sobering analog, and non-recessionary shocks have produced an average 12-month returns of close to 12%. But shocks that arrive near recessions have averaged roughly negative 9%. The difference between those two outcomes is not the severity of the conflict, it's whether the shock tips the economy into a contraction, which is exactly why the resolution timeline for the Strait of Hormuz, more than earnings, more than tariffs, more than AI disruption, is the single variable we are watching most closely headed into the second quarter. And although we ended the quarter with some early signs of potential de-escalation, which is certainly encouraging, the situation remains fluid. In the Hotel California outro, as you may know, it never resolves. The guitar fades, but the song doesn't end. It is not our job to predict when this particular cycle will resolve, but it is our job to ensure that the portfolios we manage are built to perform across a full range of scenarios that may lie ahead. Thank you for watching.